Welcome to Speaks Finance. Today we're looking at Howard Marks' investing wisdom, drawing from a lecture he gave. Marks is the co-chairman of Oaktree Capital, a firm known for its success in distressed debt and other alternative investments. He's also renowned for his insightful memos on markets and investing, which have a dedicated following. In this lecture, Marks shared valuable insights on market cycles, risk management, and the importance of contrarian thinking. One of the key takeaways from Marks' lecture is this: instead of trying to predict the future, which is practically impossible, focus on understanding where we are in the current market cycle. Marks uses this analogy of taking the market's temperature. You want to figure out if the market is overly heated with optimism or frigid with pessimism, because ideally, you want to buy when everyone else is pessimistic and sell when they're overly optimistic. And Marks has some pretty incredible stories about how he's applied this principle in real life. For instance, back in 2005 and 2006, he noticed a ton of what he called crap deals getting funded. He'd walk into his partner Bruce's office and show him an article saying, "Look at this terrible deal that got funded. If companies can raise money on this basis, the market is clearly out of whack." Think about it. The market is supposed to be the ultimate disciplinarian, only allowing good, solid companies to raise capital. But when anyone can raise money for anything, that's a massive red flag. And that's exactly what Marks was seeing back then. This cautious approach really paid off for Oaktree during the 2008 financial crisis, when most people were panicking and selling. Oaktree, on the other hand, had a reserve fund and was prepared to buy. Marks and his partner Bruce had a simple but effective analysis. Either the entire financial system was going to collapse, in which case their investments wouldn't matter anyway, or it would recover, and they absolutely need to be buying during the downturn. They saw the crisis as one of the biggest buying opportunities ever, not just because prices were low, but because they could deploy huge amounts of capital while everyone else was frozen with fear. Now, Marks is also known for his skepticism about predictions.
He'll admit he's made some accurate calls in the past, but he credits that to focusing on the rare moments when market prices are at extreme highs or lows. He compares it to assessing the probability of a decline in the next 6 months. At extreme highs, you might say there's a 95% chance of a decline, but you'd never say anything is 100% certain. At more moderate levels, the probability might be 75% or even 55% when prices are closer to a company's intrinsic value. Marks even quotes John Maynard Keynes: "Markets can remain irrational longer than you can remain solvent." Meaning if you bet heavily on an overpriced market crashing tomorrow, you could lose everything because those inflated prices could stick around for a long time. What Marks is saying is that an overpriced market and a market that's about to crash are not the same thing. And this leads into the idea of bulletproofing your portfolio, essentially structuring your investments to survive even when the market is being totally irrational, because you never know how long that irrationality will last. Another fascinating point Marks makes is about the tech bubble of the late 1990s.
In January 2000, he wrote a memo called Bubble.com that became his first big hit. He hadn't gotten much response to his memos in the previous 10 years, but this one really struck a chord. In the memo, he highlighted how bubbles are often fueled by narratives that claim something new is happening, something that traditional metrics and history can't account for. In the late 90s, that something new was the internet. People were saying the internet will change the world, so any web company is worth an infinite amount of money. And you know what? The internet did change the world, but most of those companies went bust because they weren't actually making money. They have flawed business models. Focus on things like website traffic instead of profits. Marks says you always need something new to create these narratives and justify sky-high valuations. Back then, it was the internet. Today, it could be SPACs, SaaS companies, or even Bitcoin. The lesson here is that new doesn't automatically equal profitable, and valuations always matter. Marks actually learned this lesson firsthand while investing in high-yield bonds, essentially lending money to companies considered the riskiest in America by rating agencies. What was his biggest takeaway? It's not what you buy, it's what you pay. H.E. He firmly believes that success in investing comes from buying things well, regardless of their perceived quality. In his first book, Marks includes a poor man's almanac for investing. It's basically a checklist to help assess market sentiment. Some of the questions include: do IPOs have all the power? Are lenders negotiating terms of funds? Are lenders eager or hesitant? Is capital abundant or scarce? He even jokes that if you're super popular at a cocktail party, that's a sign that things might be too euphoric. When sentiment is extremely positive, it's probably a good time to be a bit more cautious with your investments. So where are we now? Marks says we're in moderate territory, not a full-blown bubble. Valuations have been fairly reasonable when compared to interest rates, but those interest rates couldn't stay as low as they were forever, which makes valuations a bit more vulnerable. He believes the events of the past 6 months have tempered some of the excessive optimism and brought things back down to earth. However, it's essential to remember that nothing is certain in the market, and we can see irrational behavior return at any time. Now, another critical aspect of investing that Marx emphasizes is managing emotions. He points out that most people tend to buy more when the market is going up and sell when it's going down. But this is the opposite of what we should be doing. Our emotions are our enemies when it comes to investing because they often lead us to make the wrong decisions at the wrong time. Marx tells a great story about a colleague who came to him during the market turmoil of 1998, convinced the entire financial system was about to collapse. Marx's response, "Great, thanks for sharing that. Now go back to your desk and do your job." Or why? He emphasizes that a true hero isn't someone who's fearless, but someone who's terrified but does their duty anyway. The same applies to investing. You have to be able to function even when you're afraid. And that's not easy because the influences that affect the crowd and cause irrational behavior are universal. We all feel them. Marx quotes David Swenson, who managed the Yale Endowment for 35 years. Successful investing requires the adoption of uncomfortably idiosyncratic positions. Unquote. In other words, to outperform the market, you need to deviate from the crowd, hold different positions, and have the courage to stick with those positions even when it feels uncomfortable. And this brings us to Marx's idea of daring to be different. He believes this is absolutely essential to being a great investor. Everyone wants to be great, but in investing, being great means being willing to do things that are unpopular, that look crazy to others, even things that might turn out to be wrong. Remember, the goal for professional investors is to achieve above-average returns. It's easy to be average just by an index fund, but it's incredibly hard to consistently outperform. And every decision you make to try and outperform, overweighting certain stocks, avoiding others, diversifying internationally, holding cash, all these choices come with the risk of underperforming. So if you dare to be different, you have to accept the possibility of being wrong. Now, Marx also has a unique perspective on risk. He doesn't believe risk can be truly quantified even after the fact. He gives this example. Imagine buying something for $1 and selling it a year later for $2. Was it risky? There's no way to know for sure. Maybe you got lucky, or maybe you were incredibly insightful. It's impossible to disentangle luck and skill. That's why Marx doesn't buy into quantitative risk models. While he acknowledges that the past is relevant, it's not a perfect predictor of the future. In fact, he argues that the most significant losses often occur when the patterns of the past stop applying, which inevitably happens. He also doesn't believe that we can reduce all the possibilities of the future into inputs that a computer can use to determine what's risky. There's always an element of subjective judgment involved. And Marx believes that human judgment, when applied correctly, is a crucial tool for managing risk. Another important aspect of Marx's investing philosophy is learning from mistakes. He shares a story about an early investment he made in 2 tech stocks that were expected to double in price on their first day of trading. He bought 100 shares of each. The next day, both stocks had indeed doubled. When he called his broker to sell, the broker told him they were going to the moon and convinced him to hold on to one of the stocks. That stock went up to $100 a share before trading was halted. When it reopened, it was trading at $25. It turned out there was some shady business going on. From this experience, Marx learned that there are no sure things in investing. He emphasizes the need to be skeptical, even when presented with seemingly incredible opportunities. He also learned the importance of learning lessons cheaply. It's crucial to avoid those massive mistakes that can wipe out your long-term gains. This leads him to the concept of humility, which he believes is a cornerstone of successful investing. He quotes Peter Bernstein, "Humility is an enormously important quality. You can't win without it. Survival in the end is where the winners are by definition, and survival begins with humility." Marx believes humility is essential for survival in investing because you need to structure your finances and your portfolio in a way that allows you to withstand the inevitable bad times. Remember, you can't succeed if you don't survive, and surviving on average isn't enough.
You have to survive every day, especially those tough days when the market is testing your resolve. He stresses the importance of acknowledging the limits of your knowledge and being open to the possibility of being wrong. He even talks about the concept of intellectual humility, which means entering any discussion with the belief that the other person might be right. This approach leads to much more productive and insightful conversations. Now, Marx acknowledges that it can be hard to be humble, especially when things are going well. It's easy to be humble when you're winning because it seems gracious. But when things are going against you, it can be much harder to admit your mistakes and learn from them. Marx believes most people have defenses that make them overlook their flaws and limitations, preventing them from being truly humble. However, he also believes that you can learn more from your failures than your successes, because success can easily lead to overconfidence and a belief that you're infallible. The key is finding that balance between confidence and humility, being confident enough to make decisions, but humble enough to recognize that you could be wrong.
Finally, Marx addresses the challenge of navigating the massive amount of data available to investors today. He points out that we have more data than ever before, along with increasingly sophisticated tools to analyze it. Some argue that this allows us to know more and make better decisions. But Marx has a different perspective. He spent the early months of the pandemic living with his son Andrew, who's also a professional investor, and learned something valuable from that experience. His son pointed out that easily accessible quantitative information about the present is not enough to make you a superior investor. While you need to understand and process that information, it's not enough because everyone else has access to it too. To be truly superior, you have to go beyond just processing the data. You have to understand the data better than everyone else. You have to be better at evaluating the qualitative factors like the quality of company's CEO or their product. And perhaps most importantly, you have to be better at understanding the future. Marx believes that technology, while it will undoubtedly transform the investment industry, will not replace the best investors. Why? Because technology can't replicate the nuanced judgment that the best human investors possess. He doesn't believe a computer can meet 5 executives and know which one is the next Steve Jobs, or look at 5 business plans and know which one is the next Amazon. These are subjective judgments that require human intuition and experience. Computers can process vast amounts of data quickly and accurately, but they can't replace the kind of judgment that separates truly great investors from the rest. Marx spent the first 9 years of his career in equity research, but found himself drawn to fixed income investing. He always considered himself a more conservative investor, and the world of bonds felt more aligned with his nature. He even mentions Warren Buffett's quote that fixed income investing is a negative art. Why? Because bonds don't have the same upside potential as stocks. They're issued at a certain price and redeemed at that same price. So the best you can do is avoid the losers. This aligns perfectly with Oaktree's motto. If we avoid the losers, the winners take care of themselves. Marx sees his innate conservatism as a real advantage in the fixed income space. And one of the most profound concepts Marx talks about is second-level thinking. He argues that first-level thinking is simplistic and superficial, while second-level thinking is deeper and more nuanced. For example, a first-level thinker might look at a company with rising earnings and say, we should buy the stock. But a second-level thinker would consider a whole range of factors, including the company's valuation, competitive landscape, and the overall economic environment. Marx believes that to be successful in investing, you absolutely need to be a second-level thinker. You need to be able to see beyond the obvious and consider all the relevant angles before making a decision. And this is especially crucial in today's market, where we're bombarded with information and opinions from every direction. It's so easy to get caught up in the hype and make impulsive decisions, but that's rarely a path to long-term success. Marx also stresses the importance of patience and discipline in investing. He says that one of the biggest mistakes investors make is trying to time the market, buying when it's going up and selling when it's going down. That's the exact opposite of what you should be doing. Instead, he advocates for finding great companies that are undervalued by the market and holding on to them for the long term. As he puts it, time is the friend of the wonderful company and the enemy of the mediocre. If you're patient and disciplined, you'll be rewarded for your investments in the long run. Of course, Marx acknowledges that investing is not easy. There's inherent uncertainty and risk involved, and no one can predict the future with 100% accuracy. But if you have a solid investment philosophy, do your research, and cultivate patience, you can significantly increase your chances of success. Now, shifting gears slightly, Marx also touches on the topic of leadership, believing it to be crucial for success in any field, including investing. He highlights the importance of leaders inspiring and motivating others, making tough decisions, and being willing to take calculated risks. Marx believes the best leaders are those who are humble, ethical, and intelligent. They're also adaptable, recognizing that the world is constantly changing and they need to change with it. Lifelong learning and a commitment to continuous improvement are hallmarks of great leaders. Now, beyond the realm of investing and leadership, Marx also shares his perspective on success. He doesn't define success solely in terms of money or fame. For Marx, true success is about living a meaningful life and making a positive impact on the world. He believes the path to success lies in finding something you're passionate about and pursuing it with your whole heart. He also stresses the importance of giving back to the community. We all have a responsibility to help others and make the world a better place. Now, as we wrap up our exploration of Howard Marks's wisdom, I want to leave you with some of his most valuable pieces of advice. First, be skeptical of conventional wisdom. The crowd is often wrong, and it's essential to think for yourself. Second, as we've discussed throughout this exploration, be patient and disciplined. Investing is a long game, not a get-rich-quick scheme. Third, cultivate humility. Never assume you know everything, and always be open to learning from others, from your experiences, and from your mistakes. And lastly, be generous. Do what you can to help others and make the world a better place. Mark's willingness to share his insights freely through his books, memos, and lectures is a testament to his generosity and his belief in the power of education. He believes that knowledge is most valuable when it's shared and used to improve the lives of others. And Mark doesn't just talk the talk, he walks the walk. He consistently shares his insights and knowledge, not just through his firm Oaktree Capital, but also through his writing and lectures. You might wonder, why is he so generous with his time and knowledge? Well, Marx believes that simply knowing something isn't enough. You have to act on that knowledge. That's where he believes Oaktree excels. They take those insights and translate them into action. He also finds it deeply rewarding to share what he's learned and help people navigate the complexities of the market. He even tells a story about a prominent economist from the 1970s who called him up one day and said, "You changed my life." Marx was taken aback and asked how happened it. The economist replied, "I don't make forecasts anymore. I tell people what I think is happening and what I think the implications are." That's precisely the kind of impact Marx wants to have, helping people shift from trying to predict the future to understanding the present and making informed decisions based on that understanding. Now, circling back to a crucial point, Marx repeatedly emphasizes the importance of recognizing when you've been lucky versus when you've been skillful. Because let's face it, it's often really tough to separate the two. Was that investment a stroke of genius or just a lucky break? It's not always easy to tell. And this ties back into the importance of humility, a quality that Marx believes is essential for long-term success in investing. He quotes Peter Bernstein, who said, "Humility is an enormously important quality. Survival in the end is where the winners are by definition, and survival begins with humility." So don't let success go to your head. Stay grounded. Recognize that a lot of what happens in the market is beyond your control, and always be open to learning and adapting. Now, speaking of things outside your control, Marx highlights a significant challenge investors face today: the sheer volume of data available. It's overwhelming even for seasoned professionals. As he learned from his son Andrew, who's also an investor, readily available quantitative information about the present isn't enough to give you an edge. Everyone has access to the same data and the tools to process it quickly. So what sets the best investors apart? Marx believes it comes down to what you do with that data. You have to understand it better than the average person. You have to be able to connect the dots, identify the key insights, and see the bigger picture. And you also have to be skilled at evaluating the qualitative aspects of a business: the quality of leadership, the strength of their product, their competitive advantage. These things aren't easily captured in spreadsheets and data points. And perhaps most importantly, you have to develop a sense for the future. Not predicting specific events, but understanding the broader trends and forces that will shape the future of industries and the global economy. Now, Marx acknowledges that artificial intelligence and machine learning will continue to transform the investment landscape. They'll likely automate many tasks and even put some people out of work. But he doesn't believe these technologies will ever fully replace the best human investors. Why? Because these technologies, at least for now, lack the nuanced judgment that humans possess. They can't meet with 5 executives and know instinctively which one is the next Steve Jobs. They can't analyze 5 business plans and pinpoint which one will become the next Amazon. These are judgments that require deep understanding of human behavior, market dynamics, and a whole range of intangible factors that machines haven't quite mastered. And this reinforces one of Marx's core principles, the idea of second-level thinking. You have to see beyond the surface, consider all the factors, both quantitative and qualitative, and think critically and independently to make sound investment decisions. So there you have it, a glimpse into the brilliant mind of Howard Marks. Hopefully you found his insights as valuable as I did. Remember, focus on the process, not predictions. Embrace contrarian thinking when the opportunity arises. Cultivate humility and never stop learning. These are some of the key takeaways from Marx's incredible journey as an investor. I encourage you to reflect on what resonated most with you from Marx's insights and think about how you can apply them to your own investment approach. If you're hungry for more insights from leading investors and thinkers, be sure to check out other videos on our channel #SpeaksFinance. And don't forget to like, comment, and subscribe to stay up to date on the latest financial trends and strategies.